Beautiful. Hey everyone, I hope you are energized after your morning coffee and you're ready for some fantastic talks about stablecoins. This is the first time we start a panel 2 minutes before the time. Honestly, like at crypto conference, it's very unusual. Usually you're behind the schedule. So please give a round of applause to the organizers over here. Okay, so my name is Marcin. I'm co-founder of RedStone, which is the fastest growing blockchain oracle. We protect $10 billion of value on chain, support over 110 chains altogether, over 200 clients, more for Compound, Etina, and many others. And in stablecoins, I believe we have excellent experts over here at the panel. So I would like to open with all of you presenting yourself, your company, and answering a question: what's your stake in the stablecoin area right now? So, Jerald, why don't we start with you?
Great to see you. Thanks for having us here today. My name is Jerald David. I go by JD, and I'm from a company called Lynq. Lynq is a joint venture between 3 different companies in this space: Arca, Tacit, and T0, which is a broker-dealer. We've created a real-time instantaneous settlement system that is actually used to facilitate the movement of different digital assets, sometimes actually stable tokens as well. We think that there's a convergence between infrastructure now and the actual digital assets in the space, specifically stable tokens, and that we're trying to advance forward the actual movement of those digital assets, specifically for things like collateral movement, treasury management, as well as for settlement.
Beautiful. Summer?
Sure, thank you for having me. My name is Samer, and I'm with Worldpay. And to whom is not familiar, Worldpay is one of the world's largest and oldest payment acquirers. So that, putting us in the crypto space, an emerging space like crypto, puts us in a very unique position as we're at the intersection of traditional payments and digital assets. So on one side, we do support crypto exchanges, Web3 apps with accepting card payments. So a user can pay with their card, get into the ecosystem, buy their stable coins and crypto assets. While on the other side, we also do support our merchants with accepting stable coins for settlement. So this way, businesses can get paid in stable coins, not just in fiat. So I think in essence, our mission in this space boils down to bridging the gap between traditional payments and Web3 digital assets.
Excellent. Aishwary?
Yeah, first of all, thanks for having me here. Aishwary this side. I work at Polygon. Polygon is a layer 2 blockchain. I head the global business expansion for stablecoins and tokenization. I think where Polygon is today, if you look at like the numbers, 1 of every 3 transactions actually happening on Polygon is like a payment transaction. Our biggest focus has been like right now how to expand it so that like from 1/3 it becomes like 2/3, and maybe like all the transactions are payments. So that's what we're focusing on.
Brilliant. Okay, Ashok.
Hello, everybody. My name is Ashok. I'm part of the product team at Mastercard, digital assets and blockchain. So we've been in this space for a couple of years now. But firstly, I just want to thank the organizers for inviting me through. So it's actually nice to be here. But more importantly, like as a card company, we've got a card product, we've got a remittance product, we also do stablecoin settlement. So we've been kind of in this space for a number of years, and we continue to kind of expand our presence, help with liquidity and treasury management with stablecoins.
Last but very much not least, Shamus.
Thanks, Marcin. It's great to be here. And Marcin, you get best dressed. You're looking sharp today. Honored to be here with this panel. Hey, everyone. I'm Shamus Noonan. I'm from Circle. I lead blockchain partnerships there. And for those not familiar, in terms of Circle, our stake in B2B settlement and trade, we Circle through its regulated affiliates across the globe issue USDC, the largest regulated stablecoin. To date, we have around 73 billion in circulating supply on 28 different blockchains. To date, since inception, since 2018, we've settled over 41 trillion in transactions. It's both settlement as well as low-cost transactions cross-border. And then our Circle Mint account, which allows businesses to set up business bank accounts with us to mint and burn USDC. That's available in 185 countries and expanding for eligible customers. So in terms of our stake, we're hoping to continue to build the infrastructure and backbone, and really excited for the conversation today.
Excellent. Yeah, so we have two companies that are listed also, like public companies. We have two companies that have a token, which is on the, let's say, digital asset side. So now I'd like to go into the main aspects. Ashok, for those that don't know, Mastercard is 23rd largest company globally when it comes to market cap. And a fun fact, it's worth almost the same as Ethereum right now. I checked today.
I didn't know that, but thank you. That's a fun fact. I'll keep that in mind for my next panel.
Well, I wish the best to Mastercard, but I hope at your next panel, Ethereum is going to be already a bit higher. But we'll see how it's going to evolve.
We'll see how it goes.
Okay. Mastercard processes billions in cross-border payments. What specific pain points in traditional SWIFT rails are driving your client to explore stablecoin alternatives?
That's a good question. We didn't really prep for this, so it's actually a good one. For us, it's all about, we're a payments technology company, right? And we're trying to make payments as easy as possible for our customers. And we've got a broad range. We've got, regular retail customers and a big scale of B2B type of payments happening now. Now, the pain point has always been the availability of funds 24/7. Right, that's one big thing. And the other thing we're also trying to solve for is kind of conditional type payments that we're seeing a lot of, right? And complicated type payments. In the past, we find that you wanted to make a payment to a counterparty, right? So that was really easy and simple to do because, you go to your bank and you make a payment, it gets there in a day or two. And most people didn't mind that it got there in a day or two. But now, with global commerce, the ability to have better liquidity when we're using digital assets, we want to be in the space primarily because we can move money much faster. We can enable it much faster. And more importantly, our B2B customers can wrap conditionality around those tokens, can wrap regulatory things around those tokens. So, you have a self-governing, self-executing token, so you can actually look at stablecoin payments, right? So those are the things that we're trying to get into to enable this new infrastructure.
Okay, so you will be challenging Ethereum, and you're both going to go up. I understand. Thank you.
Well, I own Ethereum, and I have Mastercard stock, so either way works out for me.
Diversification. Shamus, USDC has become the de facto standard for many institutional use cases, and I recently learned that on Solana, USDC is by far the biggest, in example. How are you solving the on-off-ramp challenge at scale for traders who need to move millions daily, and what FX or compliance friction still exists?
Yeah, absolutely. And I think for us, having the Circle Mint account, which businesses can use to mint and redeem USDC, and having that available since 2018, we've learned a lot. We've seen different patterns. We've talked to customers, understanding how they're using this. And it's really, I feel like we're going to repeat a lot of this. It's having that same fiat currency depth of liquidity, ability to trade instantly, simultaneously. So that's what we're really working on our rails, working on our global banking partners. We announced a couple months ago our Circle Payments Network, so we're seeing a lot of traction with businesses there. Not as much on traders like arbitrage trading type of thing, but actual real settlement, like a steel supplier in China paying a supplier in Brazil. And the quote to settlement is 3.5 minutes, something like that. So that's really exciting for us, and we're just stitching together the banks. So in that example, they actually don't touch crypto, which is exciting. So obviously on traditional Web3 trading front, yes, USDC is listed on centralized exchanges. We work with market makers, things like that. But the actual B2B settlement trade, that's the next wave that we're hearing and trying to work together with various companies on, and we're really excited to keep building the infrastructure around that.
Very much a global system.
Absolutely.
Do we have any merchants on the audience? Raise your hand if you're a merchant. Okay, at least one, two. Okay, Summer, from merchants' perspective, what's the total cost of cross-border payment delays, working capital, FX spread, chargebacks, and how could stablecoins change that equation?
That's a really good question, and it brings to my mind an experience that we had at Worldpay almost at the beginning or early 2023. So one of our merchants, which happens to be a crypto exchange, when we were looking at the data, we found out that there's a trend happening almost every weekend you would see a huge drop in their sales or their numbers. And having a conversation with them, we found out that the reason behind it is simple. They were a new exchange at that time, and they have very limited cash flow. So they were basically relying on yesterday's sales, if you will, to fund today's upcoming transactions, or the liquidity for today's upcoming sales. And we, as Worldpay, we were collecting the funds and settling to them on daily basis, however, via the traditional banking rails, which might take up to a day, 2 days. So at that time, the happy ending to that, if you will, is that we were launching our stablecoin settlement solution. And with that, now they are being settled on daily basis, regardless it's a work day or a weekend, and that simply sorted out the issue. So to tie it with your question, there's a direct impact, and sometimes the impact can be on the revenue directly, as they were not only missing on the sales over the weekend, but one would logically derive that that user, once their order wasn't fulfilled, have went and done it on another exchange.
Brilliant. Aishwary, Polygon for me was the second network I ever interacted with after Ethereum, so congrats on being the OG in the space. How does Polygon's infrastructure handle the high frequency, high value cross-border payments that trade finance depends, and what does that mean in TPS to cost ratio?
Got it. An interesting fact on that one is, like, if you look at the non-USD currencies total trade volume, we among all blockchains control more than 60% of the share, which means not just US dollars. If you go to Brazilian reals, if you go to Mexican pesos, Colombian pesos, euro, and in fact, Singapore dollar is the second most traded currency on Polygon, after like US dollars, of course. So from that perspective, I think a lot of that is actually happening. And if you look at the cost perspective, the best part about cost is, like, it does not depend on the amount that you're transferring. So for you, like, a transfer is somewhere between like less than a cent on an average throughout the year. And from a scalability perspective, I think 3 months back, we just like upgraded the network to reach somewhere around 1,000 TPS. And Rio upgrade, which is like happening literally next week, helps us reach 5,000. So we effectively would be around 5,000 TPS at that time. Pretty much, I think it's more than sustainable. The point being, like, we can scale as the demand comes in. So one of the things that we have been doing is, the moment we reach like 40 to 50% block capacity, we effectively scale this network more. So it's not a question anymore of like whether kind of we can reach a higher TPS. We can for sure, but effectively we don't want to kind of go out and say we are to 50,000 TPS, and then you say, oh, Polygon's block is like 3% full because there's no other transaction. So I think we're getting the demand on one side. So from that demand side, we're kind of scaling on the other side, and that would continue to happen.
Brilliant. And JD, I really like that you have like the abbreviation. It's cool in my opinion. As a CEO building in this space, what's the biggest technical hurdle you've faced in getting traditional importers, exporters to actually use stablecoins operationally day to day?
Yeah, I think there's a bunch of challenges in this space right now. I think when you look back at what's happened over the past 6, 7, or 8 years, it was a lot easier to build in the past. Now there's a tremendous amount of competition that's out there right now, as we can all really appreciate. But I think that if you can find the right niche in the market, you can find the right place to focus, there's a lot of opportunity. I mean, just a second ago, Shamus was talking about how right now they don't have a solution yet for kind of transactional value for traders, right? For traders that are trying to settle transactions in a real-time basis, whether it be for trading, settlement, or otherwise. And I think that the place that we found a role is for traders specifically who are looking to use interest-bearing instruments that they can use to settle transactions between each other on a very, very, very high frequency. Now, what we've created is a private permission blockchain that allows for that settlement to go back and forth. But the interaction with stable tokens in the market is incredibly important. There needs to be off and on ramps, obviously, for non-banking hours. And that's the place I think that stable tokens interact very, very well with the ecosystem that we've built.
Brilliant. As a builder of an infrastructure project and Oracle, I can tell you that more and more when I talk with builders, they complain about those working hours. So the traditional finance has been built on the premise that the traders go to their desk at 9, then at, I don't know, 12 they go for lunch, at 4:30 you don't touch anything because it's almost like closing of the desk, and then afternoon, your remittance or like wire cannot go, right? And we are creating a space where you should be like ready to operate like 24-hour, 365 days a year.
Marcin, actually, just to add to that, a small anecdote here too. So I got here a couple days ago, and I'm like, all right, I got to go to a hawker stand. And I realized, I'm like, shoot, I don't have cash. And I was in Brazil a couple weeks ago, so I had real in my backpack. I'm like, awesome, there's like a money remittance place here. So I walked in, I'm like, hey, do you guys take real? Can I get some Singapore dollars? And he's like, he's scrambling, looking, no. And I'm like, okay, it's all good. I think I have dollars. He's like, no, hold on. He calls one person, talking in a different language, no clue what's going on, hangs up. Calls the next person. He's like, no, I'm gonna get it. 10 minutes later, he comes back with a quote like 30 to 40% above. I'm like, I'm not doing that. And that's what we're solving, right? I'm like, I'm dependent on his network of 2 to 3 people he's gonna call versus marketplaces we're all collectively building where that could have pinged out over Wi-Fi to smartphones, 20,000 smartphones, and got a bid, and I could have accepted that. Like, that is like real examples for us. I'm not a trader, I was just trying to get some food, but that's what I'm excited about in building that kind of network.
Yeah, that's a real story, right? And I hope that we will be incrementally going towards the direction where that's not going to be a problem. When you have Brazilian real, you can very easily get Singaporean dollars. But that's a good segue to the next more open question to every of you, is the FX volatility. So it's not a secret that US dollar is the global currency and American treasury bill is the global asset. But in countries like Singapore, you interact in Singaporean dollar. You go to Brazil, you have real, and so on. Like, you have plenty of currencies, and they are not going to go away anytime soon. At least it doesn't seem like. So how do you, with your company, handle FX volatility when the stablecoin on and off ramps don't exist in the majority of mid-sized and emerging markets? So you mentioned Brazil is one big market, but on-off ramps are not so easy. How do you approach that area?
Yeah, I can take that. The good thing is, like, we're bringing all the currencies. So when you look at like US dollars is a very powerful tool if you're looking from a perspective of countries where the currencies are depreciating against US dollars. So LATAM, Africa, like, there has been amazing adoption. But when you're looking for countries where like that is not a very big issue, a lot of people actually want to hold their regional currencies. And because of that, effectively, one of the things that we have started focusing on is exactly FX. So I think a very kind of a contrarian kind of a comment would be, like, on-chain FX rates would never be better than off-chain FX rates. And the reason being, like, if you like just compare a pair between US dollars and euro, it's the most liquid pair on earth. And like, there'll be always someone, if you're doing it at size, will give you like a better rate. Like, but if you combine 3 things together, like being a treasury manager earlier, one of the things that I would look at is, okay, is it only the FX rates that I'm saving? But the answer is no. Let's say when you're trying to go out and do a transaction which takes 2 days, you are getting into 3 different problems. So one, your cash is in transit, which means it is not earning anything. Second, because you are in a different currency than US dollars, and if your like reporting entity is in US dollars, you need to hedge that currency. And then the third is, like, while that you don't even know till the end what is the final money that you're getting, because that is what you have to negotiate from the bank. Like, I used to do that as my day job, like back in American Express. So effectively, if you combine all this and the cost that you would incur, which is like the opportunity cost that you lose when effectively that money is in transit, the cost of hedging, and the swap rate. If you combine all these 3, that's where on-chain becomes much powerful. And that is where, like I always say, that you need to have like a full package on-chain to be able to provide that, so that like effectively you are able to go like a US dollar which is earning a yield while in transit, or like money getting transited instantly, so that there is no, like, you don't have to hedge it. All these things are like super important when you have to build that market. And like, we are, like, if you look at the total market, like notional value that gets traded every day, it's around $7.7 trillion, something around that. So there are only 19 currencies which are actually secured, which means that there is an insurance. When you send the money, someone else will send you back the money in cross-border. Like in 2008, there were like a couple of banks which started one-side movement. The whole 2008 fiasco happened, and they never got the money back. So I think what the world is not looking at is around a notional amount of $2.3 trillion, which moves on a daily basis without insurance, and that is a very important market. And instead of like, and a lot of people are like only focused towards kind of just saying, okay, US dollar, it is important for sure, but like you have to think about a lot of other economies where essentially like people are much more happier, like I think Singapore dollar.
Yeah, I mean, in Poland we have zlotys, and it's not a meme coin, it's a real currency.
Exactly.
I pay it like every day, trust me. Any other like views on that?
Yeah, I mean, so Shamus, you could have just used a Mastercard to pay for your hawker food and settle with us in USDC. That would have been easier instead of waiting for a thing.
I saw the cash only sign.
Yeah,
so
well, most places will take Mastercard. But I mean, like, see, for us, I mean, we settle now in 30 different currencies, and we have liquidity for those currencies on a global level. So with our network, we're able to kind of give you the best rates already in fiat. So similarly, as these newer stablecoins kind of come up as well, because even though predominantly today you've got USDC or USD denominated stablecoins, but we are seeing Hong Kong dollar come up, Aussie dollars come up, Japanese yen. At least in the region, there are a number of stablecoins coming up. And these are all currencies that we settle with already in fiat. So we have the best possible rates to settle in stablecoins as well. And we can settle multiple times a day. That way you're, going back to my earlier statement, you have better liquidity.
James, actually, do you know the number off the top of your head of what the current US dollar denominated stable token transactional numbers are versus like other multi-currency ones? I only know because Ripple had a report that came out that said it was 95%, and that was like earlier this year, but I'm not sure if you have a current number.
Sounds about right. I don't have any numbers off the top of my head.
Okay, so I will open a Pandora box. I'm going to ask a question you guys are not ready for, because it popped to my mind. Everyone knows that in stablecoins there is network effects. You can imagine a galactic network, and there's sun, which is the US dollar, and there are other planets, there are other currencies, right? Like there's euro, there's Brazilian real, there's Singaporean dollar, there's yen and yuan and whatsoever. But all over the world, we have like what? Over 100 currencies, maybe even 200 currencies? I don't exactly know, but there are plenty. In this global world of blockchain, where settlement is 24/7, 365 days a year, and everything will probably be denominated into dollar, do you believe there is room for those smaller currencies? I'm not talking Brazilian real, I'm talking about Vietnamese dong, or I'm talking about some African currencies that have actually fairly small market cap in comparison to Mastercard market cap, right? Like, is there even a room for them, or should we like reinvent how they are thinking about the currency of their own?
I mean, as someone who has most of his net worth in US dollars, I would take like a contrarian approach. I think we are going back to the world, like, I think the point, like the 95% of the money movement happens in US dollar is something which is being enforced as a dominance. Why? Because like effectively when you use SWIFT, you don't have most of the currencies. And ultimately, like even in India, like when you want to transfer money, INR is not on SWIFT. So effectively what you have to do is you have to necessarily and forcibly convert that money into US dollars to move it. So saying that 95% money moves on US dollars is like you can say it's correct, but how is that reaching that point is completely different. And because of that, like the way I look at it is, if you want to move forward, we need to kind of bring in more currencies. Sorry. We need to bring in more currencies, and we need to let the people decide. Like, the power of blockchain is, I'll have a US dollar, I'll have regional currencies, let the people decide. Like, I think the market, like, let the market kind of decide, let the user base decide what they want, rather than kind of enforcing a rule or a law which says that, okay, if you need to use our system, you need to convert into a certain currency, and only then you can do it.
There are two thoughts that come into mind there, right? One is retail use cases versus institutional use cases. And you're thinking about retail use cases, this hawker, kind of example, which I think is quite appropriate. You'd like to think that there would be an evolution of, kind of different currencies that are evolving that folks could use for that retail use case. But I think that's also what the big talk was 2 years ago or 3 years ago, which is the CBDCs, right? I mean, I think that's what they were supposed to be trying to conquer, which was you take an actual currency that's issued by a national government or a federal government or some sort of an agency. You take that and you offer a digital version of that. That conversation's kind of fallen away as of late, and that probably is kind of the genesis of the question, but maybe more so is kind of the answer that no one really has yet.
There's sorry, go on. No, I mean, I look at it as two pieces, right? Like, what is your end goal? If you just want to move your money, you can move it in US dollars on a global level, right? It's about usage. Like, so similar to what his example earlier, right? If you have US dollar in your wallet, most countries, and maybe Vietnam, you can probably use US dollar directly at a merchant, right? But at the end of the day, they still want Vietnamese dong. Or maybe the first tier would accept US dollar, but the second and the third tier will not accept US dollar, right? So you still need to have that domestic currency to kind of move and do things with it, while you could use US dollar as a movement of currency between the network, right? But that's really what you really need to decide.
Very good. So, thank you, Ashok. Samer, you wanted to add?
Yeah, I also wanted to add on what Aishwary has just said is, I think change and adoption to a better system or faster, cheaper one doesn't mean that it necessarily should be different in everything. There should be some type of replication in terms of if the current system relies on different and multiple currencies to serve specific regions and geographies, let it be. But then I also connect with what Aishwary said on the market will decide, and there will be players to come up to build those solutions of conversion and such.
Okay, that wasn't an easy and it was a provoking one because I know your big brains, and those are not easy questions to answer, right? Like the traditional economy has been evolving for hundreds of years, right? And the system that we have today is an effect of years of forging it, right? And now we are disrupting it completely with new rails, so you just have to sometimes also think out of the box, at least. That's my take. And another topic that is related, CBDC, central bank digital currency. Is it that or is there something in it? Any opinions?
I can take a shot at this one. I mean, we've at Mastercard have done a number of like CBDC type of initiatives, like in Hong Kong and Singapore and in Australia. On a retail level, I mean, there isn't really a reason to have a CBDC, right? At least in Asia, most of the domestic payment networks are really, really strong and really, really efficient. So I don't see a value for a CBDC, unless, of course, you talk about potential government grants to use the money for specific purposes, right? But on a wholesale settlement CBDC or a wholesale CBDC, I feel there's value to move money across the banks much more efficiently, or even cross-border. There is value in having a wholesale CBDC, but a retail level one can be easily replaced by USDC or any other stablecoins out there and serve the same purpose, right? So that's my personal opinion.
I kind of agree with that because, like, been working with a couple of CBDCs. One of the biggest thing is like, why do you need a CBDC? And again, like what Ashok already said, like at least in the Asian markets, like we have much more efficient ways in which like the currencies are moving, and you effectively do not need it at a retail level, but you 100% need to go out and have it like on a wholesale level, because like interbank settlements using CBDC, a system designed by the central bank, which is regulating all the banks itself, it becomes like much easier to kind of go out and settle. So 100%. I think it would be a mix, but retail, I think nobody has actually been successful yet.
Okay, I can tell you from the builder's perspective, I hear less and less about CBDC. I believe that was like 2023, 2024, that was exploded, and everyone was like, every country is going to have like its own CBDC, every like Circle is not going to exist, Tether is not going to exist, it's going to like be moved 180 degrees, flip on the head, but now we hear it less and less, but there's some merit to it still, I believe, right? Like we are going to see how it's going to evolve. Let me take a step back. So stablecoins are tokenized currencies, in a sense. You can tokenize many other financial products, like American T-bill. There's, for example, BlackRock BUIDL. Apollo A-Cred is tokenized private credit, and we're going to see tokenization of other financial instruments at large. We, as the RedStone, deliver price feeds for those to ensure that on-chain, the value of those assets is accurately responded. But with this whole tokenization explosion, there are coming risks. And there are risks of an oracle, so that we could, for example, price it wrongly on chain. There's a bridging risk when you're moving USDC or any other asset like across many blockchains out there. What are your thoughts about one, tokenization, so moving those traditional finance rails on chain versus accepting legally that the things that are living on chain are the native ones? Like if some crime happens on chain, you cannot revert it back on the traditional rails. You just accept everything that is on chain. Do you have any thoughts about that?
I'm happy to take a stab here. So I manage all of our blockchain partners at Circle, and we're live on 28 blockchains. And what some people still don't know is that for every blockchain USDC natively deploys on, we actually write the smart contract for it. We integrate it into the Circle Mint account. We do all this in-house. And a lot of reasons why blockchains reach out to us is when it's issued natively, it's under our terms and conditions that it's USDC is always redeemable for dollars. Full stop. So like through our MTLs, MSBs, all of our regulations, that's always redeemable for dollars. We've redeemed trillions of dollars since inception. So for us, that's really important. Like in a lot of distribution providers are like, hey, we can't touch a wrapped asset. We can't bridge things. We need to only be able to move it in a regulated on and off ramp provider or an account. So that's really important to us, and that's why we're continuing to expand to other new blockchains. In one of the areas we're thinking about from tokenization plays, we have USYC under the Circle umbrella now, our tokenized money market fund. So we'll keep innovating on the tokenization front, but obviously safety and security is a big one. And with our cross-chain transfer protocol as well, it's a mint and burn approach rather than a lock-in mint. So I would say compliance is, I joke, we act more like a bank than a Web3 company a lot of days. Compliance is always at the forefront of everything we do in terms of product expansion.
Shamus, thank you. And terms and conditions. This is something you're going to see more and more in crypto. When I talk with like some native builders that are frogs on Twitter, they say, what, compliance, like regulatory stuff? No, I'm afraid. And then we have like serious people knowing that in order to move this industry further, you just have to embrace it, like regulatory aspects, like terms and conditions, and things like work in regular bank. And you do something wrong, you take a hit. You pay a fine or you try to solve the issue over there. JD, you wanted to ask something?
Yeah, I do. I think that there's a difference between regulated instruments, really, and that's what you're talking about, right? And like, when we talk about USYC, you're talking about something that's being issued under under the CFTC, right? That's a commodity pool operator. And there's some very, very, very different regulations you have to adhere to when you're doing that. Same thing for BIDL, which is offered under the SEC. And I think that there's a stark difference. There's also different clients that are actually going to want to and demand to have those different assets if they're going to touch them. There's AML, KYC considerations that are involved there. And I think that the universe of options that are out there, even ones right now that we're talking about, specifically ones that are interest-bearing, the far majority of them that are allowed, specifically under Genus and MiCA, are only ones that are issued issued under the statute of a federal regulator. So there are some really, really different use cases, and there are others that are also going to demand that they use a regulated product versus something that, kind of maybe, kind of categorized in a different way.
No, I think the gentleman covered it way better than I can do. Nothing to add.
Okay.
I mean, if I may.
Go ahead.
So, at the end of the day, we're still a payments company, right? And a lot of people don't realize what goes behind a payment, right? There are a number of factors that we put into place in ways of governance frameworks and dispute resolution. You just kind of assume all of that stuff happens in the background, right? So it is important as more of these assets get tokenized on chain, when you make a payment for it, what is your recourse? What happens if you send the money to the wrong spot, or you don't want to buy it, or you want to even return it? So those are the things that we're kind of dealing with now to say, what is your dispute resolution methodology? So companies like ours and companies like yours are kind of putting together some of these frameworks and governance models that we feel are important to move forward. It isn't about regulation as much as like make it easy for the customer to interact with this new technology, right? Because the easier you make it, it's going to be more scalable and people will use it more. And that's what we're really trying to get to. In the last 18 months, we're seeing a lot more usage in the space compared to where we were a few years ago. Right, you had really, really high touch points recently just because of what's happened, and it's made it easier for people to get into it.
Brilliant. With all the regulatory aspects, we have to understand the risks that are associated with assets. There's probably way different risk when you're interacting with USDC versus a synthetic stablecoin, like for example Ethereum, versus a stablecoin that has zero transparency and just gives you a pinky promise, hey, you deposit money, we are going to make some yield on top of that, and don't worry, man, like everything is going to be all right. We probably remember Terra Luna crash, right? That was a pretty painful one for some of the people. So let's talk about the future. So personally, I'm extremely bullish on ratings. That's the reason, as RedStone, we recently acquired a company called Credora to introduce risk ratings, similar as it is in traditional finance. You have S&P, Moody's, Fitch, and some bigger financial institutions even cannot interact with financial products unless they're rated, right? So this is like a pace towards which I believe we are going in the future. But today it's October 2nd, 2025. Fast forward 3 years ahead, so we have some time. By 2028, what percentage of global B2B cross-border payments will use stablecoins? And do you have any other predictions for the 3 years to come?
Sure. So at Worldpay, we haven't done any studies on this just yet. We do not have any official numbers. But from my experience and the merchants I deal with, it's obvious that stablecoins would bring the most value where speed and cash flow efficiency matters the most. So I think even a shift of 5 to 10% in sectors like e-commerce, digital assets, think of import and export. So a shift of 5 to 10% would unlock billions in liquidity for those sectors. And my personal opinion is that is the shift that we're going to see amongst the lines of 5, 10% until the next 3 years.
I think you're going to continue to see an increase in the stable token utilization for sure. I think that's unquestionable. But I think you're also going to see a rise in tokenized money market funds. They're going to be used. I think that there are a ton of different use cases right now where yield in a compliant and regulated way is going to be demanded. I think that if you think about the way that the financial institutions are going to operate, they currently are very, very liquid in U.S. Treasuries. So there's no reason why they shouldn't be, if they're seeking for regulated solutions, equally as proficient in utilizing tokenized money market funds and other different instruments that are out there to facilitate the actual transference of value while at the same time capturing the yield that's out there.
I think yesterday I just wrote an article on the same thing, which was, and the concluding line was, in 5 years, if you're still using ACH, it would be like thinking about I'm using my cloud server, I'm using my in-house cloud network because the on-chain cloud network is insecure. So it's something like that. And that being said, I think a lot of that volume, if that has to kind of come on-chain, you have to fundamentally kind of alter the way the money moves. Because the way the money moves today is still you can move the money in stable coins, but ultimately the settlement is happening in fiat. And I think Worldpay does that as a use case where effectively when you're doing that, when you're moving money, they give you money in fiat. And I think Mastercard and Visa, they have started accepting stable coins. So a lot of that has to actually move on-chain in the sense of once you've received the money, you can actually spend that stablecoin itself to do further payments. And that is where if that adoption curve happens, you need to fundamentally alter the way the money is being used on chain. It's today, after receiving, a lot of thing that happens is I think with Worldpay, every day at the day and all the settlements happen and all the money goes back to the bank. So even if you say the volumes are happening on chain, they always off ramp, and which means that the harder we all are trying to bring money on chain, this is next day it all goes off chain. So the volumes would increase, but once we change that fundamentally, where the use case of stable coins actually expand, and that is so if we are able to do it, at least in 5 years that I've been thinking of, is we'll see at least 20 to 35% of that movement happening on chain.
Just a disclaimer that as Worldpay, we did add via Circle a couple of years ago the ability to settle in stablecoins. And we're seeing that shift even from traditional merchants like retail, travel, airline. At least some of the big names are now in the phase of asking questions, trying to explore how can we make that happen. And some smaller ones or medium-sized have implemented it due to higher speed and lower costs.
Step by step and then all at once. Ashok, besides Mastercard exceeding Ethereum in market cap, what else do you envision?
No, I mean, like, look, I think 5% is a good optimistic number, right? I mean, I know Aishwary is talking about 25, 30%. But I mean, for us, it's not about the tier one acceptance. I can move money from point A to point B in stablecoins, that's fine, right? The key is going to be, how do you get the next level of acceptance? Now, if the next level of acceptance will not accept stablecoins, a US dollar one or a local currency stablecoin, then it becomes a little bit difficult and tedious, right? So the thing we have to think about is your question about just moving money on chain on the first level from like one point to another? Sure. I mean, there could be 5%, right? But then, the downstream vendors and the suppliers for these people need to also accept it, and they should be able to spend it downstream as well, right? So it's a tier 2, tier 3, tier 4. If that is there, then obviously the scale is much larger. But initially, I mean, I think five is a very good optimistic number for 3 years. We should hit it. I'm fully supportive of it. We'll try and be there as much as possible. But what we're trying to do is build that next level of acceptance downstream as well, either using our existing networks or our partner networks.
We all need to use stablecoins to hit that 5%. Shamus.
Exactly. I feel like we're in San Francisco in 2012, 2013, when a lot of friends said, hey, you should download this new app called Uber. And a lot of friends are like, hey, or a Lyft, like they have a pink mustache, and you give the driver £1. But I really feel like it's the taxi cab to Uber transition right now. Like the innovation's ahead of regulatory. For some countries, others are embracing it. But I feel like once you have that magic, and I was listening to the last panel, it was really insightful. Like, there's so many complex regulatory things for sending a cross-border payment that maybe on the retail side, I'll send a friend USDC and I'll worry about it later if I wasn't supposed to do something. But for a business, right, you have a fiduciary of responsibility, your customers and shareholders. So there's a lot more there. So like, you need the end-to-end regulation and laws in place, but once that's done, the tech's there. We can show it, like all of us respectively can show it our companies. But I feel like it's that whisper network of, the head of payments at a company or head of treasury, like, have you tried moving money with stablecoins cross-border? Like, holy shit, that was really fast. And it's an actual fraction of the cost. So I feel like we're there. We all need to respectively onboard 1 to 2 people. And like Uber, I mean, there was awareness, but it was the referral network with your friends that really got things going.
I'll just add on to that one. I think 2 weeks back, we were doing like a presentation for one of the biggest payment providers, PSPs in the world. And like they were like, yeah, stable coins. So they had called like their CEO, like their entire C-suite, and a couple of their merchants. It was like a first like a presentation, so explaining them what is a blockchain. One thing that we did at the end of that was we actually put up the merchants that effectively use them. And we figured and all these merchants were effectively doing some of those with stablecoins. So the moment we showed those slides that your top merchants are effectively exploring stablecoins and on-chain finance, that was like the biggest thing. So even like the presentation did not end. It was like, okay, can you tell me what this person is doing, what this merchant is doing, what this merchant is doing? And like, I think they wanted to come on chain probably end of next year, but they are now doing a pilot early next Q1.
Very exciting. We're going to do more of this.
Samer, you wanted to add something?
Really quickly, I wanted to add, because on what the gentleman added is a very interesting case we had recently is wherever you see innovation, then builders will build. And there's a very interesting app. I'm not promoting for them. I'm not a shareholder. It's called Lynq. And what they do is very similar to Cash App or Venmo, but all based on stable coins. So you would transfer money on C2C or P2P side, peer-to-peer between your friends, colleagues, regardless the currency, they are basing it all on stable coins in the back end. So the user is not expected to have any experience in crypto or stable coins. They top up with euro, sent to their friend in Australia. Their friend would be able to withdraw back to their bank account, credit card as in Mastercard Send or Visa Direct, all powered by stablecoins in the back end for faster speed and lower costs. So these are the type of things that I think will make us hopefully hit that 5%.
Yeah, I mean, no, that's different, right? I mean, like you're talking about remittance. Like remittance is a very good use case. And for the actual money movement about larger corridors like US or the Philippines, like Middle East to India, where you have a little bit of a pain point, you can actually get the money there much faster. And Mastercard Send will actually get you into those wallets or your card or your bank account much more efficiently at the fraction of the cost, right? So those are the kind of things that we are trying to enable for these things.
All right, my bold prediction, in 5 years, every fintech company is going to be a crypto company at the same time. Revolut, Robinhood, Prix in Brazil, whoever, all of them are going to have, of course, the traditional finance rails, but also the crypto rails, because otherwise they are going to be out of the business. We are heading towards the end of the panel, and I wanted to thank you all for the audience. This is the first panel I'm on at Token 24/9 that is full, by the way, because there are so many competitive panels, right? So really great that we have big brains over here. Closing thoughts. For companies in the audience considering stablecoins, what's the one thing they should do tomorrow to get started?
I'm compelled to say, start building with Circle and USDC, but even taking my Circle hat off, right? Like, just start with a pilot. Go talk to your treasury team. Like, hey, if we were to pay a supplier in this country with a stablecoin, what would that look like? What are our requirements? What do we need to do? Let's say we want to send $1 just to test. Just start with a pilot. You don't need to do a whole overhaul of your treasury team. So that's where I would start. We're obviously doing a lot. We care. We're super passionate about it. So reach out to Circle if you want to learn more about USDC. But I would say just start really small, see the magic firsthand, and go from there.
Take this first Uber ride.
Exactly right.
Yeah, I think for me as well, I think this is something we've been doing. It's more like we're not putting the Polygon hat when we're talking to a lot of PSPs and fintechs. The bigger thing is when we're talking to them, we're just saying we're going and giving them a rundown, because the problem is with stablecoins coming in, a lot of things are changing, and it becomes much scarier when you introduce them to 5 different players saying this is good because this is there. So effectively, and we're seeing that with a couple of fintechs where what we've done is we have tried to introduce them with a couple of partners, and now all those partners have given them different presentations, and they are scratching their head in the sense of what does that mean? So I think what we have been doing is across the world, we've been trying to go out, have a full session with the management, and trying to explain to them what all these things are, how they should approach, and then being more with them in the sense of helping them as someone who's consulting them, but not kind of saying, okay, you should do it on Polygon. And that is really working out, because a lot of the problem that is coming in is lack of understanding of how these things happen, and it is scary because people have never done it. And so that's why, I think, like Shamus said, doing a pilot is really well, but also if you're kind of exploring things on the side of stable coins, that is what our approach is.
Yeah, I think it's less of the POCs, right? For the years and years and years, you've had banks and large-scale financial institutions, and all they're doing is POCs. I think it's time that we start putting things into production. Finally, we start putting, kind of the assets in the hands of the users and start really building the way that we've all anticipated it's going to happen.
Yeah, I think you should definitely ask questions, right? This is a perfect opportunity. There's a bunch of people here in Singapore at this current time, specifically around stablecoins and payments. So talk to people, talk to us, talk to the other people out there. We're all trying to we're all in a way blind in a way for now, but we're trying to figure stuff out. And the more you work with us, we can kind of figure things out together. And we actually will be able to solve problems that you're having rather than just building something that can't put into production.
Beautiful. Summer?
Yeah, definitely. I think one thing not to do is to not start with the technical aspect of it, because then it might look overwhelming and you're not looking at the benefits, rather the investment or the cost that you have to put in. But as Shamus mentioned, starting with the treasury team, finding where the pain points are with your whole process, and then implementing a simple, low-risk use case would show you where you can best implement stablecoins for the highest benefit.
I would say follow all of us on Twitter and download the wallet. Do your first transaction. Thank you very much for that. That was brilliant.
Thanks for having us.
Thank you. Thanks, everyone.